We're happy to have you today, man. I figured we just I want to talk a little bit, obviously, about what you guys do and what your differences are, and then a little bit about the space and a little bit about your background, if that sounds good.
Absolutely.
All right. Well, if you want, man, kick us off with a little bit of an intro of really your background would be great to figure out how in the world you got to where you're at. That'd be great.
That's a good question. So I'll try to be brief. I'm 38 years old, a father of three. I started my career probably realistically at the age of three. My father was one of the earlier engineers in the country, and I had my first computer at the age of three. Then later on in high school, I started developing and doing some cool stuff. When I went to high school, I went to a class that the majority of my classmates were also geeks and computer programmers. And I grew up in Israel, as you can hear by my accent. And when we turned 18, we're mandated to join the military. Now, the majority of the developers or early age developers typically join the military on the cyber side or intelligence corps, etc. I took a different route. I decided to do a lot of pre-army training and do something that will also challenge my body and sort of other skill sets. So I ended up joining the military to the Air Force Commando unit and was
Oh,
trained as a combat soldier, as a sniper, parachuter, and some other interesting trainings. But not only after I finished my military service and started to study law and accounting, I figured out that my passion is in the technology space, and actually decided to drop my career path as a lawyer or accountant or both and join my first startup. So I joined the first startup in 2010. They were in the cloud computing space where people barely knew what cloud computing even means. I had the opportunity to join them as a marketing manager, knowing nothing about marketing nor about management. But I guess they didn't want to spend much, and hopefully they saw the potential. So I was hired. Was a very interesting journey. 2 years later, I joined other two co-founders and started a startup in the e-com personalization space. We ran for 4 years and then we got acquired. And afterwards, I joined a neobank and served as chief of growth. And that's sort of the beginning of the curve that gets me closer to where I am today. And after a good year and a half with the neobank, I joined the small sister of the fintech industry, an insurtech company named Plank, where I led sales, BD, and marketing. And after 4 good years with Plank, I decided to move on to my next journey. Now, the problem that me and my co-founders spotted at this point was very intriguing for us. We figured out something that probably all of our listeners already forgot, that the majority of small businesses that are the backbone of our economy just don't get access to bank-rated capital. Or in other words, 8 out of 10 business owners that apply for a loan with their primary bank relationship, whether it's their local community bank or other regional banks, and even more so with the larger banks, they're just gonna get, sorry, we don't do sub $100,000 or sub $50,000, or you're a restaurant owner, so we're not gonna do even $500,000, and so on and so forth. And after speaking with about 25 bankers at Money 2021, we figured out that A, it's a real problem because as an entrepreneur, second timer, I figured out that I don't want to create a problem that nobody cares about. I rather find a real problem, a big problem, and then do my best to solve it. So we figured out that A, it's real. And some even told us that the numbers or the stats that we found through some online research and consultants like McKinsey and others not necessarily even reflect the full reality, as A, the data that banks manage to gather is related to data that came in to their loan origination systems to begin with. And that doesn't include an immediate no from bankers saying, hey, don't waste your time because my bank is not going to do that. And on the other front, some smaller community banks said that actually approve way more than the 20% on the average, but that's fine. That's why it's an average and not segmented per size of the bank. And the reason is just that they have way less. The smaller community banks, sub-billion dollar, have way less demand. So in order to deploy capital, they have to do something, even if it's not necessarily within their perfect appetite. Then after we figured out it's a real problem, obviously we're not the only smart people in the world, if at all, and not the first that spotted this problem. So the next thing we did was talking with some of the founders of the alternative lenders out there. They have been around for over a decade. A lot of them, or at least some of them that I'm connected with, did pretty well in terms of penetrating the market and gaining significant market valuations. But what I found in common that all of them are suffering from very similar symptoms. Number one, they all suffer from high cost of acquisition. Number two, they have high cost of capital because they're not a depository bank. So they need to secure this capital through some other credit facilities. And I'm not sure that the models that the all smart people and all the models that they've developed outperformed the traditional 100-year-old models of the banks. So we figured out that solving this problem through alternative lending is not necessarily where we want to be. And the fact that at my previous role, I managed to work and sell and partner with insurance companies, which are pretty much similar to banks. I wasn't afraid of the challenge to actually collaborate with banks and partner with banks toward a possible solution to the problem.
It's a real problem, man. I mean, look, we see this, whether we're talking about small business, personal, et cetera, it's the small dollar loans that used to be, I think, bread and butter. And there was a lot of that went on. And slowly that sliding scale has moved up, right? I mean, you named off a lot of the reasons. Certainly it's staffing, it's cost, right? It's funding and capital. Regulatory is another one, right? There's a lot of pressure, and all of the compliance things. And then areas of the market, when you think about the business side, a lot of people kind of pick a niche, right? Where you have certain skill sets that are necessary, so it's a big puzzle. And I think what's interesting to me too, is we saw, to your point, the alternative lending side kind of accelerated that takeaway, so to speak. But then to your point, we've seen a lot of those folks struggle. So it feels like a little bit of a give back moment, right?
Yeah, there was a big fail there, overall for anybody to, once we reached the competition for capital, they began to kind of unwind a little bit. And so really we get back to, it costs as much to do a small loan, $5,000 as it does to do $50,000. And so we've got to figure out how to get those costs down without losing our bank policy along the way. What is it we're trying to accomplish here? What is a good qualified loan? And bending the rules is never a great idea, but finding new rules is always a good idea, right? And so this is where I wanted to really talk to you today. There's an element out there. Let's kind of just start back from the word AI. AI and lending, boy, that just seems to make a lot of sense, particularly on the business side. But I think there's just a lot of bankers out there that this is still a fairy tale. It's not real. And I think as it becomes more real and we are able to cite examples of how to actually do this and how to use AI in banking, that's one of the places where I think a lot of people just completely fall apart and they don't understand it. So tell me, what are your sources? How do you guys go about using AI and what you do?
That's a good question. So back to your point about AI, I think that CEO of banks want their people to bring in AI as they do understand the potential. But I think that aside from your podcast, probably one of the main sources of education is the vendors. And I think that's in a way a bit of making the entire conversation about AI maybe too high level, if you will, and not what actually AI can do for them. And unfortunately, a lot of companies that are talking about AI are actually behind the scenes. It's more of a rule-based solution, like if this, then that we've seen around for years. Tying it to the regulatory point that you mentioned, where I don't think AI should play an important role yet, is on the actual modeling side. and which loans should be approved. But I think there are a lot of areas that AI already plays an important role when it comes to the smaller ticket items. You talked about the unit economics problem. So that's where they can get a lot of efficiencies by utilizing AI technology without using it as a black box that regulators will hate, I guess, forever, and until someone unboxes it or sort of uncovering the black box. But then I'd say it's in the path of development of AI and LLMs, I think it's almost impossible to uncover all the factors that led into a decision. So until the regulator will adopt more of a back testing kind of mentality to make sure that there are no immediate biases compared to the data that they care about, like 1071 is a good example, they will forbid using it for decisioning or modeling per se. Now, how can that be utilized in other fronts? So we like to break down. So sorry, go ahead.
No, that's great. I like where you're headed with this. I've talked to people a lot about if you just turned AI loose right now, you would find an unbelievable bias machine that's terrible, right? But in the processes that go through making a loan, what's the best next step, right? There's efficiencies that can be gained there that are tremendous.
And that's absolutely how we see it and sort of how we rolled out our solution. So before I jump into AI, Llama AI is part of our name. I'll just say briefly, how did we approach solving the gap in the small, medium business loan market? And then I'm going to break it down to smaller components and how AI can be utilized in order to solve these gaps one after the other. So in order to solve that, we didn't want to become yet another alternative lender or the new version of alternative lenders, which is kind of embedded alternative lenders. So they cut off the cost of acquisition if they embed into a vertical SaaS solution or anything else, but they still have the high cost of capital, the limited models, and so on, and yet to be seen if they can outperform, the defaults in the market with the unique data that some of the vertical SaaS companies do have. And I wasn't afraid, as I told you, to collaborate with banks. So we figured out if you can beat them, join them is a good strategy for that purpose, as they already have over, again, according to surveys and statistics, over 70% of the business owners that apply for a loan will start a journey within their primary bank relationship. That means that there is a lot of money left on the floor as they already see the opportunities with super high intent at the moment of need. So if we could help them to fund those deals, those opportunities that they don't want to fund, we're solving problems, A, to the business owner, that they don't need to go around to another bank or to the local private lender or to online alternative lender or to their friends and family. They would get a yes from their primary bank instead of a no. The primary bank relationship will keep the client happy. And we all know that community banks is mainly about relationships. And the other party, the bank that actually deployed the capital, because it's within their expertise, like Tara mentioned, that they all have their only 4,500 or so of community banks, each with their own expertise, they get a risk-free opportunity that otherwise they would never see because they're very local within their own geography. So that would create a win-win, not just 3, 4, because we're also here, for profit. So that would make I don't know how to say triple in 4. If anyone we can help me, but that's a 4 wins strategy.
Can we call it a forfer? Can we just call it a forfer? It's a forfer. Forfer.
Forfer. We thought, and again, that was a beginner's mistake, that a lot of them already have some sort of automation around the LOSs and open APIs and whatnot. So we can just build a standardization middleware leveraging AI and some other capabilities in order to get a package or a partial package from Bank A, standardize it, and then spit it out the way that the system that Bank B uses want to see it. What we learned very early on the journey, that a lot of them are still running the processes with pen and paper and Excel sheets and email exchange between the borrower and the banker, and then between the banker and the analyst, and between the analyst and the underwriter, and between the underwriter back to the banker because they have some additional questions, and then back and forth until eventually the package and the deal is signed, and then they're sending it to the closer. And then it's another few other people from different departments that they need to check on DNB, and then to write it to the core, and then to fund the account, and then to document all the paper in their documentation system, and so on. So just building the standardization layer and creating the network by bringing on banks on board was a good idea, a nice try, but wasn't realistic enough.
A little too early, just a little bit too early. Yeah.
And that's part of the huge opportunity that we see, because we did start gathering the banks, mapping their appetite, getting their on board in terms of their intent and their willingness to see deal flow and to see new opportunities. Who doesn't want to see new opportunities? While we built the AI-driven open API loan origination system that already solves a lot of the pains that they have around the unit economics, etc. So not only allowing them to participate in a larger network play and embed themselves into other banks and into other channels, like digital marketplaces that today it's mainly ruled by alternative lenders that are plugged into the digital marketplaces around business lending. So allowing them to plug into new sources of deal flow, while also helping them to better underwrite their existing client base. So how do we do that? We broke the LOS, the conceptual LOS, to three main pieces. Number one is what we call the contextual onboarding. And that's the ability to get only the data that you need from the borrower that you cannot complete in any other way. Meaning, if you have access to open web data, right, from, for example, the website of the business, and the Secretary of State getting the certificate of incorporation, and plugging in a lot of data sources, we can basically augment a lot of the questions that otherwise the person would need to declare. Furthermore, plugging in their QuickBooks, right, can reveal a lot of their financials. So maybe the financial statement, although it will be required as part of the regulation and the processes of the bank, but you already know at an early stage if they're cash flow positive and what was their annual sales in 2023. So that way, the more data that we get and the more access that we get along the way, including the answers that the borrower submits, the less question or the more relevant question that we can ask. So the system automatically optimizes upon completion of the application at the minimum time possible. Now, on top of that, part of the more of the cooler features around Gen AI is also having the ability to help the client understand what's missing. And I'll give you some example. Imagine that someone uploaded their financial statement and the system automatically crunches it, and I'll speak about what the system does behind the scenes on the underwriting piece, but bear with me for a second. And it does identify a decline in sales between October 2023 and January 2024. Is it a good business? Is this a bad business? Who knows? But what we do know and what the system does know, that the underwriter will ask additional questions down the line and basically would have a future back and forth with the client to understand the context here. So the system can chime in and say, hey, either it's an AI bot on behalf of Bank X. We did identify that you had a decline in sales, 30%, decline between those months. Can you provide some explanation? So the person provides the explanation. The system, again, doesn't understand if it's true or false. What it does understand if it's correlated to the question and not just yes, no, thank you, whatever that is, and then take the answer and try to quantify it according to other data that it has on file to make sure if it seems right. Again, we're still not at the level that it can say, this person is lying, or no, this is actually true. But we have a lot of indications and anomaly detections across different pieces of the data in order to understand if that will be enough for the underwriter to get the context they might be looking for. So that's just the onboarding piece. And within the onboarding, again, a lot of smaller pieces of AI utilized to standardize data across different sources, all the way from, QuickBooks is just one example, but you have 20 other systems used by SMB. So we provide access and connectivity to those platforms as well. But part of it, the system cannot work, with different kinds of data sources. Otherwise, we'll need to do too much of work mapping all of these sources. So we created a component that standardizes the data no matter which channel it is coming from. Moving on to the underwriting or decisioning, that's where things start to get even more interesting when it comes to AI. A lot of the work of the analysts and underwriters and the bankers are around the package collection and getting this data, which we automate not just through the optimization of the onboarding, but also through email channels, push notifications if they have an app, and also text messages, right? So that's more of the Gen AI coolness, to make sure that we're cutting the time and the human effort to collect the data, but then analyzing the data and automatically declining, for example, those opportunities that don't fit within the bank appetite. That's a huge gain in time saving, because otherwise a person would need to review something just to say it's not a fit, meaning they're wasting time on non-revenue generating activity. So that's one part of the underwriting that we managed to save a lot of time for banks. The other side, which is even more interesting, the new capabilities utilizing LLMs in order to spread different type of financial documents. So if, in the past, 10 years, I think there were two ways to do that, either manually in-house or offshore, or utilizing some OCR technology just to extract numbers without context. We had the luck to build up the company when LLMs are already widely used and available. So we build this component ground up with the ability not just to crunch tax returns, that's very easy, it's standardized, that's a no-brainer, that's the rule-based I talked about before, but also financial statements and audited or not audited, which can come in many different shapes and forms. And the more our clients see, the more that they want, because, okay, if you can do that, can you also do rent rolls, or can you also do this? So there is a lot of appetite around automating those pieces, and then understanding the context and identifying any anomalies or duplicates or other things.
For a second. So part of this, for the people that aren't keeping up with what we're talking about, it's language modeling, right? So there's certain things that you're looking for, the understanding of what a word means, an association word association, right? And so as you're going through this process, it would be like, how do you teach a person at a college to do financial underwriting? And then you say, okay, here's our bank policy, right? And so our bank policy, if he's got a debt ratio of this or that or whatever your policy is, so you've got to teach this person credit analysis, and then you've also got to teach them your bank policy. And so when you put that together, and let's just say in the computer, that allows them to do things much faster at an efficiency level that's blink of an eye. Did I do okay there?
Absolutely. And I want to double down on that point, that we don't have any intent to replace the analysts or the underwriters, right? But just to equip them with capabilities so they can do more of the high value work versus all the tedious manual data entry and copying from a PDF to a spreadsheet and then to another system. And I think the point that you're making is also very true around the great employee shortage. I think it's also very hard for banks to attract and hire people that they need today in order to keep up with the volumes that they see and will see when the macroeconomy changes and rates go down. So even if they're able to hire people now, they need to train them, as you mentioned. And all in all, it's very hard to scale when it's manual underwriting tasks, and also to keep up with the bank policy in a consistent manner. Very hard to track that as well. And I think the part of the machine piece in it is to make sure that you're consistent across your credit decisioning at the bank, again, according to the bank policy.
Perfect.
Hey,
There's so much of this, guys, that really comes back to, there's so let's we syndicate a lot. We want to take this out until I don't have to be focused on geography like I once was, right? We all have participation, so we have all these different things that we work on. This is taking everything from making a loan to participations, all of this stuff, much bigger and faster is really what we're talking about, and an efficiency level that hasn't been seen before. I stress this to bankers all the time that there's nothing fintech is doing. There's nothing going on magical outside of banking that you can't do. You can do every bit of this that they're doing. They can't do what you can do because you have a charter. So a lot of what we're trying to do in some of these series here is just educate bankers a little bit on this is what's coming. They're going to use these things to try to beat you. And the more you understand them, the better you're able to implement those things on your side to actually be a more efficient and competitive banker. And in the end, because you have that charter, you've got a significant advantage. Like when you were talking about the alternative lending, right? You find it's just hard to compete with these guys. Think about that. That's the fintech world saying, hey, it's hard to, our alternative fintech world saying it's hard to compete with a bank. And the banker world, I think their point of view is they don't know what the hell's going on, trying to understand this stuff, trying to see where it's going. What should I do? What should I not do? How much of this is fairy tale and how much of this is real? But again, back to the idea that if we understand everything, we can compete at a level they can't. And so let these guys blaze a trail. Let them do the things that they want to do. And then go out there and figure it out and implement it on your bank side. And this is what I love about your company and what you're doing. You're actually taking that extra step.
I have a llama story for you.
All right, go for it.
First off, I want to know why llama only has one L, because I'm pretty sure it has two L's.
But it's not the animal.
Right.
It's not the animal. Okay. I have a story about the animal for you. So my grandfather actually brought the first llamas to Texas. And I recently found this out from a family friend, and I was like, what? How did I not know this? But okay, so it's not llama the animal.
But was it a llama or alpaca?
It was a llama. It was a llama. Yeah. This was before the alpaca wool craze, and llama wool was a big deal. And so that's what they were doing. But
So
tell
the
me,
thing-
okay, so not the animal. What does llama stand for?
Sure. So don't tell it to the Money 2020 organizers, but back in 2021, they had a special prize for startup companies. Now, me and my co-founder were bootstrapping, and we didn't have the amount of money, to invest in a few $1,000s for entrance ticket. So we did come up with a name and a website and a logo within a couple of hours to be considered as a startup. And I actually took the name after the Dalai Lama, just representing sort of global wisdom and connectivity and do good. And the domain was free. So initially it was llamabanking.com. It was llamabanking.com, and then we upgraded to llama.ai after we raised our seed round.
That is outstanding, man. I love that story. Hey, I want to give you the last couple of minutes for any final thoughts, man. Anything that you're focused on thinking about. And I do want to mention, man, I thought the background in Israel and your military background and the service and everything, I know that's probably done a ton for you, and you probably have positive reflection on those things looking back. I think it's really cool. So I wanted to mention that. But I want to give you the last couple of minutes, man. Final thoughts, anything that's on your mind.
Yeah, so I want to connect to Dave's point on helping bankers understand. And I think that one of the things that in general I see that they struggle with is the ability to do MVPs, right? Like startups do. So there are some CEOs of banks over there that say to their teams, hey, we need to increase deposits. And someone will say, all right, we need to have a new digital account opening in order to do that. And everybody say, okay, thumbs up. And then 2 years later, and I'm saying it in a negative way, 2 years later, does it more dramatic? And $2-3 million in investment, they're launching their digital account opening, and then nothing happens because they didn't figure out the new channels or the new sources that they're gonna get the new deposit. So one of the things that we're trying to educate the market, and again, we're very early on our journey, just 2.5 years in this game, but I think that they need to test their thesis first. So it's kind of quick and dirty, automate 90% of the work, let's say onboarding and decisioning, but don't plug it to the core until you manage to prove that it brings value. As an example, so instead of doing 100% manual work, do only the last 10%, the last mile. Prove that it works, and then spend as much as needed. Of course, not $2-3 million, but whatever. And then another half a year in order to complete all the fine tuning and connecting it to different systems.
I can't tell you how smart what you just said is for a banker to hear. MVB, by the way, is minimal viable product, right? So you've got MVP. It's the initial, the idea of fail fast. If this isn't going to work, let's not screw with this, right? And if it's something that's going to work, let's test out key pieces, and then we can take it one step further, right? And so that's how software is developed just all over the world. That's just how this works these days, because it's faster. And again, we fail faster so that we can move forward with things that are actually going to work. But to a banker, and I want to, don't take any hard punches off the table when guys, you're not product builders. This is not what you do. This is what you think you do, but it is not what you do. You're not any good at it. Let people that are good at it show you how to do it. And I think what you just said was brilliant, that they're not product builders. They don't even know the basic wheel route of how to go about this thing. And so you end up with a deal, just like you said, you spent $2 or $3 million, you're 2 or 3 years into this stuff. And again, it's because somebody trying to make a living teaching you this stuff is convincing you that's the only way to do it. When if you'd actually run it like a business, whole different ballgame.
Well, and Dave, I'll add to that some of them are great product builders, but sometimes it's not enough, because the thesis is not about how great the customer experience is and how great and rightfully the product is built in the right order with the right systems in place, but is figuring out the entire hypothesis on whatever your goal is. So try to fail fast. See if you manage to crack the acquisition channel, if you manage to crack whatever you're trying to crack, and then scale.
Man, perfect. Did you solve a problem, or what problem were you trying to solve? Or did you achieve anything, right? It's measuring what the hell we're trying to get done here. And I love what you just said about it. It's not about the user experience, the customer experience. That is the most overused bullshit. And it's just simply not true. If you can save me time, I'll pay a higher rate, i.e. Rocket Mortgage. There's things out there where people are like, you're kidding me. They'll actually pay more money if you can save me time. Man, I'm one of them. That's the most valuable commodity I have is time. And I'll pay a lot of extra to be able to have that. And there's other people that are like, I'll do anything to save $1. Okay, so the user experience, the customer experience has nothing to do with solving those two problems sometimes. I'm not trying to belittle that concept. I'm just saying it's an overstated concept that we all use so much of the time. And it's all these stupid talking points that really drive us in the wrong direction towards solving real problems. And I think companies like yours and other companies out there in the fintech space, and I just use that in the broadest sense of the word, technology. Man, it's a great place to learn from. It's a great place to understand what's going right and what's going wrong. And here's another one. Just, man, when you said to think about the Dalai Lama and trying to get in the door at Money 2020, that's how entrepreneurs think. We think about fixing, so how do I solve the problem the fastest, easiest way I can? Not how do I build a whale? Well done.
Awesome. Hey, man, I got to tell you, I really enjoyed it. This is a super cool conversation.
Me too.
I really got a lot of wheels spinning, man. I want to thank you for helping, like you talked about, helping to educate everybody. And you did so in a really good way today. So thank you for your help, man. Appreciate it.
Thank you for inviting me. It was a pleasure.
We'll see you next time, man.